The financial world watched with bated breath as President Trump's aggressive trade policies sent shockwaves across Asian markets. Trump's tariffs, intended to protect American industries, had sparked a global trade war. The impact was immediate and far-reaching. Asian markets, heavily reliant on global trade, bore the brunt of the uncertainty. From Tokyo to Seoul, stock prices tumbled. Investors reacted with panic, selling off assets and seeking safer havens. The world held its breath, wondering about the long-term consequences of Trump's gamble. Japan, a nation known for its export-oriented economy, found itself on the front lines of the trade war. The Nikkei 225, Japan's benchmark stock index, plummeted by nearly 9%. This was the index's most significant single-day drop in years. Japanese automakers like Toyota and Honda, heavily reliant on exports to the United States, saw their share prices plummet. Electronics giants Sony and Panasonic also suffered. The sudden downturn sent shockwaves through Japan's business community. The once mighty Japanese economy was reeling, unsure of what the future held. The tremors of the trade war were felt far beyond Japan's shores. The economic ripples spread across Asia, hitting major financial centers with unprecedented force. Hong Kong, a global financial hub, witnessed its Hang Seng Index tumble by a staggering 8%. Investors were in a state of panic as the market reacted to the escalating trade tensions between the United States and China. The bustling trading floors, usually filled with the hum of activity, were now scenes of chaos and uncertainty. Tech behemoths like Alibaba and Tencent, pillars of the Chinese economy, saw their valuations plummet. These companies, which had been riding high on the wave of technological innovation and global expansion, suddenly found themselves grappling with a harsh new reality. The sharp decline in their stock prices sent shockwaves through the market, raising concerns about the future of China's tech industry. Taiwan, a major electronics manufacturing hub, experienced its worst-ever single-day loss. The island's economy, heavily reliant on exports, was particularly vulnerable to the trade war's impact. Factories and businesses across Taipei braced for the fallout, as the uncertainty in the global market threatened to disrupt their operations and supply chains. The Taiwan Stock Exchange weighted index plunged nearly 10%, wiping out billions in market capitalization. Traders and investors watched in disbelief as the numbers on the ticker boards turned red, signaling a massive loss of wealth. The financial community in Taiwan was left reeling, trying to make sense of the sudden and severe downturn. The message was clear. Trump's tariffs were disrupting global supply chains and shaking investor confidence in Asia's economic powerhouses. The interconnected nature of the global economy meant that no country was immune to the effects of the trade war. Ports and shipping terminals, the lifelines of international trade, were now scenes of congestion and delay. The economic landscape of Asia was being reshaped, with long-term implications for businesses and consumers alike. The situation in South Korea was so dire that trading on the Kospi Index, the country's benchmark, had to be temporarily halted. The index, heavily weighted towards technology and manufacturing giants like Samsung and Hyundai, was in freefall. The halt, a rare occurrence, underscored the severity of the situation. South Korea, a key player in the global technology supply chain, was staring at an uncertain economic future. The tariffs threatened to disrupt the intricate web of trade that had fueled South Korea's remarkable economic rise. In the face of global market turmoil, President Trump remained defiant. He defended his tariffs as necessary medicine, arguing that short-term pain was essential for long-term gain. Trump believed that the tariffs would protect American jobs and force trading partners to offer more favorable deals. He dismissed concerns about the market reaction, asserting that foreign governments would eventually come to the negotiating table. Trump's stance, however, was met with skepticism and apprehension from economists and world leaders alike. Economists and financial experts around the world sounded the alarm, warning of the potential consequences of a full-blown trade war. The stakes were high, and the ripple effects could be felt across various sectors, from manufacturing to technology. Experts highlighted that the interconnected nature of today's global economy meant that no country would be immune to the fallout. The potential for job losses, increased consumer prices, and disrupted supply chains was a cause for concern. Financial markets were already showing signs of stress, with volatility indices spiking and investor confidence waning. The uncertainty was palpable, and the need for a strategic response was urgent. Deutsche Bank, a leading global financial institution, compared the market shock to the 1987 crash, the 2008 financial crisis, and the initial COVID-19 panic. Analysts at the bank noted that the current situation had unique complexities, given the geopolitical tensions and the fragile state of the global economy post-pandemic. They emphasized that the lessons from past crises should guide current policy decisions. The bank's report suggested that coordinated international efforts were essential to mitigate the risks. The potential for a prolonged economic downturn was real, and the stakes could not be higher. They cautioned that the tariffs could trigger a global recession. The interconnectedness of global supply chains meant that tariffs on one country could have cascading effects on others. Economists warned that the trade war could lead to a decrease in global trade volumes, affecting everything from raw materials to finished goods. The potential for inflationary pressures was also a concern, as tariffs could lead to higher prices for consumers. The need for diplomatic solutions and negotiations was more critical than ever. The economic landscape was at a crossroads, and the decisions made in the coming months would shape the future. The Greek central bank governor predicted a significant slowdown in euro area growth. He highlighted that the eurozone was already grappling with structural issues, and the added pressure from a trade war could exacerbate existing vulnerabilities. The governor called for a unified European response to the crisis, emphasizing the importance of solidarity and cooperation among member states. He also pointed out that the European Central Bank might need to consider additional monetary policy measures to support the economy. The potential for a double-dip recession in the euro area was a growing concern, and proactive measures were needed to prevent it. Billionaire investor Bill Ackman urged Trump to reconsider, warning of an economic nuclear war. Ackman, known for his outspoken views, argued that the long-term consequences of a trade war could be devastating. He pointed out that businesses thrive in stable and predictable environments, and the current uncertainty was detrimental to investment and growth. Ackman also highlighted the potential for retaliatory measures from other countries, which could further escalate the situation. He called for a more measured approach, suggesting that dialogue and negotiation were the best paths forward. The stakes were too high to gamble with the global economy. The consensus was clear. Trump's tariffs were a dangerous gamble with the global economy hanging in the balance. Financial experts, business leaders, and policymakers all echoed the sentiment that the potential risks far outweighed any short-term gains. The global economy was already facing numerous challenges, from climate change to technological disruptions, and adding a trade war to the mix could be catastrophic. The need for international cooperation and strategic planning was more critical than ever. The world was watching, and the decisions made in the coming days would have far-reaching implications for generations to come. As Asian markets reeled, talk of retaliation filled the air. The European Union, a staunch advocate for free trade, threatened countermeasures on billions of dollars worth of American goods. China, the primary target of Trump's tariffs, vowed to respond in kind. The stage was set for a tit-for-tat trade war, with no clear winners in sight. The prospect of a protracted trade dispute sent chills down the spines of businesses and investors worldwide. The global trading system, painstakingly built over decades, was teetering on the brink. Amidst the gloom and uncertainty, some saw a silver lining. India, with its vast domestic market and growing manufacturing sector, was viewed as a potential beneficiary of the trade war. As companies sought to diversify their supply chains away from China, India positioned itself as an attractive alternative. Experts speculated that tech giants like Samsung and Apple might relocate production to India to avoid tariffs. While India's stock market initially slumped alongside its Asian counterparts, the long-term outlook for the Indian economy seemed more optimistic. As the dust settled on the initial market shock, one thing was clear. The global trade landscape had been irrevocably altered. The once seamless flow of goods and services across borders had been disrupted, leaving businesses scrambling to adapt to the new reality. Companies that had relied on just-in-time supply chains found themselves facing unprecedented delays and shortages. The ripple effects were felt far and wide, from small businesses to multinational corporations. Trump's tariffs had ushered in an era of uncertainty and volatility. The imposition of these tariffs was intended to protect American industries and jobs, but it also led to retaliatory measures from other countries. This tit-for-tat escalation created a climate of fear and unpredictability in the global markets. Investors were wary and stock prices fluctuated wildly as news of new tariffs or trade negotiations broke. The long-term consequences of his actions remained to be seen. Economists debated the potential outcomes, with some predicting a resurgence in American manufacturing, while others warned of a prolonged economic downturn. The uncertainty made it difficult for businesses to plan for the future, and many were forced to make tough decisions about layoffs, closures, and relocations. Would the tariffs achieve their intended goal of protecting American jobs and reducing the trade deficit? Supporters argued that the tariffs would level the playing field, making it more attractive for companies to produce goods domestically. They believed that this would lead to job creation and a stronger economy. However, critics pointed out that the increased costs of imported goods could lead to higher prices for consumers and reduced competitiveness for American businesses abroad. Or would they trigger a global recession, hurting the very people they were meant to help? The interconnected nature of the global economy meant that the impact of the tariffs was not confined to the United States. Other countries felt the strain as well, with some industries facing significant disruptions. The potential for a global recession loomed large, and the stakes were high for everyone involved. One thing was certain: the world was watching, anxiously awaiting the next chapter in this high-stakes game of economic brinkmanship. The decisions made in the coming months and years would shape the future of global trade and economic stability. As policymakers and business leaders navigated this uncertain terrain, the eyes of the world remained fixed on the unfolding drama, hoping for a resolution that would bring stability and prosperity for all.